Okay, I'm going to go over the problems from exam 1. Ajax Corporation sales last year, $500,000. Operating costs, $362,500. Interest, $12,500. What's the times interest earned, TIE? Well, EBIT is 500 minus 362.5. TIE is EBIT divided by the interest. Alan and Sarah Winthrop are a married couple who file a joint income tax return. They have 2 children and they have legitimate itemized deductions totaling $27,550. Total income from wages, $251,400. What's their marginal tax rate? A tax table was given. It was 24%. The reason this is marked in red. Baskin Bakery paid out $35,000 of common dividends, ended the year with $215,000 of retained earnings. Prior year's retained earnings, $159,600. How much net income did they earn? The answer in the test was $91,000. That's incorrect. It's $90,400. So if you missed this, I gave you credit for it. I don't even take that out. Okay, there's Koski's balance sheet and income statement and data. Current ratio, current assets divided by current liabilities. Quick ratio, current assets excluding inventory divided by current liabilities. Inventory turnover, sales divided by inventory. TIE, EBIT divided by interest. ROA, net income divided by total assets. ROE, net income divided by total equity. Earnings per share, net income divided by shares. Price earnings, price per share divided by earnings per share. Market to book, price per share divided by book value per share. Hahn Corporation sales last year at $450,000. Year-end receivables, $52,500. Firm sells on terms that call for customers to pay 30 days after purchase, but some delay. How late? Their average sales per day is $450 divided by 365 days. DSO, you've given the formula. DSO is equal to end-of-year accounts receivable divided by sales per day. If they're paying in 42.58 and you want them to pay in 30, they're paying 12.58 days late. Godinco Corporation, $372 million of sales, $75 million of fixed assets, 80% capacity. Full capacity, 372 divided by 0.8. Harrington had sales of $325 and a net income of $19,000. Year-end assets, $250,000. Total debt to total capital ratio, 45%. They only use debt and common equity. The question, what's their ROE? Profit margin, net income divided by sales. It was given. Total asset turnover, sales divided by total assets. Equity multiplier, total assets divided by equity, multiply them together. Myers' total invested capital is $670,000, and its total debt outstanding is $185,000. New CFO wants to establish debt to total capital of 40%. What do they have to add or subtract to do that? Well, 40% of 670 is 268. They're at 185, so they need to add the difference. Precision Aviation had a profit margin of 6.6%, total asset turnover of 1.5, equity multiplier of 1.8. What's their ROE? Multiply them. Prez's company's balance sheet showed total current assets of $3,500, all of which were required in operations. Current liabilities consisted of $975 of accounts payable, $500 of 6% short-term notes payable to the bank, and $250 of accrued wages and taxes. What's their net operating working capital? Current assets minus accounts payable minus accrued. Net notes payable was irrelevant. 44. River Corporation's total assets at the end of the year were $320,000. Net income $35,000. What was the return on assets? Net income divided by total assets. Royce Corporation's sales last year were $280,000. Net income $24,000. What's their profit margin? Just divide them. Vasudevand recently reported operating income of $2.3 million, depreciation of $1.2 million, and at a tax rate of 25%. Firm's expenditures on fixed assets and net operating working capital total $0.65 million. Free cash flow. That $0.65 is that right there. So they've given you EBIT times 1 minus the tax rate plus depreciation minus that. And 47, Woo Systems has the following balance sheet. Assume that all current assets are used in operation. How much net operating working capital does the firm have? Its Current assets minus accounts payable and accruals. There it is. DeSoto Corporation's sales are expected to increase from $6 million to $7.5 million. Its assets total $3.5 million at the end of 2020. It's at full capacity. Current liabilities $1.1 million, consisting of $300,000 of accounts payable, $500,000 of notes payable, $300,000 of accrued liabilities. Profit margins forecasted to be 6%, and its retention ratio is 40%. How much in additional funds will they need? Okay, here's the parts label for you. There's S0, S1, the change in sales, A asterisk, the sum of these two right here, with that one and accruals. Those two are L asterisk. There's profit margin. Plug all of those in. There's your parts, $545,000. This is back to the Costco balance sheet up there. They want day sales outstanding. They've given you accounts receivable and sales. So that's sales per day, then accounts receivable per day divided by sales per day. Not good, 60. Last year, Hendorf Zoo had $850 million of sales and $425 million of fixed assets that were at 85% capacity. What's the maximum sales growth rate the company could achieve before it had to increase its fixed assets? Well, at capacity, it's 850 divided by 0.85. They could add then 1,000 minus 850. They could add 150. So the added sales is 150 over 850, 17.65%. I have checked the correct box now. If you go into your grade book, go to your grade, click on the arrow to the right. It should allow you to view details. When you go to that, view attempt, and you should be able to scroll through and look at every question on the test, look at your answer and the correct answer. Any questions, as always, let me know.